In this video, guys, we're going to look at the beauty of resting orders. Stick around. Hey traders, warm welcome to you. Thank you for joining me. All right, so resting order, I'm talking from a perspective here of a limit order, not necessarily a stop order, which we know is ultimately still a resting order to a certain extent, but really the limit order perspective and why. I think more traders can leverage on the power of limit orders. We tend to default to a market order to get in and a stop to get out. That seems to be how most people operate. Market in, stop out. But have a think about using some more limits to get in. I did a video exclusively about limits and kind of some of the focus areas on this, but this is expanding the concept a little bit and kind of introducing some new ideas. So before I carry on, guys, do check out our channel sponsor, which is a link to them in the description below. Expand the description, click the link and go and have a look. CFD, spread bet, multiple different markets. You know the score. They have been our sponsor for a while. Some great feedback from them, multiple different markets, multiple platforms as well, and super tight spreads. If you're in the market for a new trader, a new broker, should I say, go and check them out. Okay, so beauty of resting orders. So I'm going to go straight in with the kind of most unusual one, I guess. Anchor your trade to a specific level. So what do I mean by this? What on earth am I trying to say here? Okay, so when you are trading, we tend to anchor, in other words, how the trade is performing, look at how the trade is performing relative to our entry. So if our entry is 100 and the price is 101, we're like, oh, it's up $1. We feel like it's up $1, it's doing okay. If it's sitting below, we're like, oh, it's not doing so well. And our anchor point tends to be right at our entry. And there's a little bit of a challenge with this because it's an arbitrary level, unless we've got the low of the day or the high of the day, or maybe an open or a close or another key level. It's a meaningless level. It's an absolute meaningless level the way we've got in. And so to consider whether the market is strong or weak or how it's performing relative to that entry is almost a foolish thing to do, and it can get you in trouble. So the better thing to do is to anchor it to something more important. So if you're putting a limit order in, most of the time, it depends how you're putting limit order in, to be fair, but let's say most of the time you're going to be putting it at levels of resistance. If it's a long, you're going to put just over a breakout level. You're going to put it at a cluster of kind of range, prior range. You're going to put it at a key level, right? And this, maybe if you're scaling, you have multiple limits. But then you can see, it's easier for you to see when the limit order is in, how the market, how far away it is from that limit, how it's behaving when it approaches that limit. So your anchor point can change from your entry to actually your exit. And so it reframes something in your mind and goes, okay, well, is the market still strong? Is it sucking the price towards my limit, or is it pushing it away from it? How far away am I from? What is the response when we get to it, or we nearly get to it? And the anchor changes to my entry, where it's going further and further away, and it almost doesn't matter how far away it gets now. I encourage you to close the position too early, rather than it's coming closer and closer and closer to the limit. Okay, let me look at it and see. Oh yes, it's doing all right. It's going to keep going. It's going to keep going. It's getting closer and closer as opposed to getting further away. So there's a subtle difference, but something to consider is the way that you anchor and think about the trade relative to what you think about it to your entry. That's how most people think about it. Try and undo that. And if you don't, by the way, let's just kind of go off piste a little bit here. If you don't anchor your trade to your limit, then at least try to anchor it to another key level. But I'm saying that this is probably going to work for limit because most people have their limits at the key levels, the key support, the key resistance levels, prior highs, etc. Because there's obvious places to take some of the trade off. The second thing is the ability to walk away from the screen. Of course we know this, but we don't leverage on it, guys. We feel like we're going to miss something. Oh, I'm going to miss this, I'm going to miss that. I want to see what's happening. And most of the time it's detrimental to our trading. Most of the time if we're at the screen and we're battling away and we're looking, we're going to close too early, we're going to overtrade, we're going to think we've seen something we haven't. And in reality, you have to be comfortable and go, I'm in this trade now for the rest of the day. I'm going to come back later. However, if we do spike in price and I'm long, I want to make sure I capitalize on that. And so you can put your staggered orders in, you can leave your resting order in, and then you can go and do something else. And you've done the hard work, the trade is just cruising away. Hey, if it suddenly goes and rockets, I'm not going to miss out, I'm going to capture it. I feel comfortable with leaving it. And if you want to come back and check it every now and then, fine, but you're not then sitting in front of the screen and feeling like I've got to do something. I should take it straight off the table. It's not doing anything now, it's stagnating. That goes out the window, and it's more of a case of, has my limit been filled or not? So the ability to walk away from the screen is something we don't leverage on enough as traders. Third thing, guys, is you can catch short-term price spikes. So one thing that used to be a very, very kind of good strategy in some of the thinner markets, like in kind kind of some of the thinner shares would be to put like resting limits in at key quite low levels to catch price spikes. But of course now, this will change with algos and stuff, but still, you can still use limits to catch these little spikes in price. I alluded to it earlier, but let's say you've kind of got a high you're looking to take the trade out of. Very often, depending on what you're trading, imagine if it's breaking through that low or breaking through that high, very often you get that real kind of wicky of a candle. If you've got a limit in, you're going to be able to take advantage of that. So let's say, short's a great example because it often happens more to the short side, if I'm honest. Your short DAX goes down, it goes through a low. As soon as it hits that low, very often it kind of cascades through and then comes back quickly. If you've got resting limits in, maybe you've got 4 or 5 scaling out limits in, you're going to be pinged, then you're going to be filled. Pepperstone will fill you, fine, they'll cover your short, great. If you are there watching it, by the time it's done it, come back up, you probably haven't got time to execute the trade. By the time you've got the trade ready and by the time you get a ticket up and all this stuff, it's done it so quickly, you haven't been able to take advantage of it. The fact that you've got the limit order in already means that you will be filled on these price spikes. So taking advantage of short-term price spikes. Nothing to say, by the way, as it's getting there, you go, what, I think this trade is going further, I'm not going to put the limit in. This is a price spike catching limit only, I'm going to pull it. If that's what it's there for, it's like if we suddenly spike massively through the low, I want to capture it. If we just go through the low and break and then hold, I'm pulling it because I think we're going to go further. That's fine, but that is literally in there just to catch that immediate volatility, that kind of suck of liquidity vacuum that we often see on the order book, and that cascades over to the lower, tags your limit, bang your fill, pops back up. The final thing is it allows you to be more disciplined. We kind of know this intuitively, right? Because we say, okay, I think my trade's going to go from here to here, maybe here, maybe here, maybe here. Very often we cut the trade early. Very often we meddle with the trade. You can literally say to yourself, okay, so if you're going to exercise discipline and you're trying to get better at your discipline, you go, right, it's stop or limit. It's my target or it's my stop. That's it. And you can make it a binary event. It either hits one or it doesn't. It either hits one or the other or it doesn't. It's as simple as that. There's no meddling, there's no moving, there's no messing around with it. It's a very, very simple way of looking at the market, and it allows you to exercise the discipline muscle, allows you to kind of stop meddling with trades, stop over trading, etc. Same with you getting into the trade. If you're getting into trade with a limit, it's going to hit your level or it's not. Now, there are downsides to that. I think the hybrid kind of strategy is better when you can use a bit of both. But if you're struggling with discipline, you're struggling with meddling, you're struggling with chasing, all these things, then utilize limits. Say, hey, market's gone up X. I don't want to chase it. I'm always chasing stuff. Let me put a bid in halfway, leave a limit, leave a resting order, leave the screen. If I get filled, great. If I don't, fine. It's a good way to improve your discipline. All right, guys, the beauty of resting orders. Don't